Hello. Welcome to this episode number 10 of Chasing the Deal. This time we are going to analyze an industrial property in Atlanta, home of Martin Luther King and also the headquarters of Coca-Cola. For those of you who likes sugar and taking and drinking a refreshing Coke, you will like Atlanta. So Atlanta, it's a big city, big metro area in the southwest of the U.S., and it's a very interesting growing manufacturing hub. And we are going to see how to develop investment strategy to invest in some industrial property and then get some dollars out of it. So uh, follow me and let's get into that. Okay. So in this screen, for those of you who have not uh, watched any Chasing the Deal episode before, this is my CoStar software. This is a very useful property intelligence software uh, for real estate professionals and developers and investors as well. And you can see huge amounts of market informations here. And also you can see all properties that are for sale and for lease here. Uh, Talking about commercial properties, we can see industrial, office, retail, multifamily, hospitality, even student housing here. So for this, since I'm specialized in industrial and office buildings, we are going to see the market data for Atlanta on industrial. Okay, so let me show you this nice screen here. The first screen we see here, it's for the market information. It's we see some summary numbers here, some key performance indicators here, like the inventory space available on Atlanta for industrial properties, that it's almost a billion square feet, 868 million. It went up from the last year a little bit on inventory, not too much, like 10 million from 857 to 867. So that means not a big deal here, not a big developers throwing a lot of new space here, or at least if they are, we are absorbing this. That's why we don't see a huge raise on the inventory. Then we have this under construction. Here we have uh, also a growing numbers, like 1 million more, 1.5 million more, from 19 million to 20 million square feet on new construction in Atlanta. Uh, that says a little thing about how developers or investors are thinking about Atlanta. So if they are building new space, that means they are trusting in the market. Okay. Net absorption. It went down. That's not a good thing, but it's not that bad because we still have a positive absorption. That means more people or more tenants moving into the space than people moving out and leaving the space vacant. So we have from 6 million to 4 million here. And the vacancy, a little bit of raise on the vacancy, like a 0.5% here. So that's not good thing, but it's not that bad as the other numbers because it's only 0.5% here. So we have a little more back in the space here. So market asking rent growing. growing rent, it's always a good thing. Okay, because sometimes it grows just because of inflation, but sometimes it grows because more demand on the market. So the last thing, well, one of the last things is the market sale per square feet. It went up from the last year, $130 per square feet average, to $126 per square feet average. This is for average space. It counts new spaces, old spaces. So this is an average. And finally, the market cap rate. When the market cap rate goes down, it is a good thing for the owner of the property. Okay, because they are the property is pricing more, but it's not as good thing for the investors. Okay, because they are paying more for that. Okay, but it also means for investors that that the market is getting hot. Okay, or maybe it's a good market, because if the cap rate goes down, that means many people are purchasing on those on that market, or maybe the Fed rates are going down. So for those who follow me, you know that when the Fed rates go down, it pulls all other assets like real estate. So cap rates go down, and also if the opposite, if they goes up, cap rates go up. It's the same thing. Okay, so um okay, so here basically we see like Atlanta, it's a good logistics hubspot. Okay, but as it says in this report, it's better for, or many companies are looking to manufacture in Atlanta. Okay, because maybe it's because it's close to Mexico, maybe it's close to other ports, like in South Carolina, like in North Carolina, and maybe also in Georgia. I don't remember if Georgia has ports. I may be wrong, but I think it has. But it's close to the ports. It's close to the south, and also it has a cheap labor. You know, companies are looking for cheap labor. You know, they are always looking to make more money. So if you have cheap labor, ports, and you have and you are close to other supply chains, like in this case Mexico, that's probably you have a good industrial market there. Okay, so that's the case for Atlanta. Okay, okay, so let me show you some other key performance indicators for um, numbers. Like we can see here some comparison trends between the market and the national. So we can see, for example, here the asking rent here, it's lower than the national here. Okay, because again, this is an average. Because if the national, if you see, for example, in New York, in the northeast, or maybe in the west, you have for sure more expensive rents there. Okay, so this is another thing why companies are moving into Georgia or to Atlanta, because they have cheaper rents there. Okay, that doesn't mean it's a bad market. Okay, because what we want to know, it's not how much is the rent, but how much we are putting in, investing, and how much we are getting out. Okay, how much we are making. Okay, so the vacancy rate, it's along with the national rate, 7.5% for the national, and for Atlanta it's 8%. Okay, So vacant square feet, um, 70 million, and for the national 1.4 billion dollars. Okay, availability. The difference between the vacancy, it's we have here also the subleased space here, and also the space that it's not vacant, but the tenant it's not going to renew the lease. Okay, so we are counting up this uh, those numbers here, and that's why it's higher than the vacancy rate. Okay, so we can see here, for example, available direct leases 82 million, and sublet 12 million. Okay, so some companies are trying to get rid of some space that they maybe 5 years ago they rented out, and then they are trying to sublease because they want to recoup some cost, you know. Okay, available total months on the market, average again 8, and the national 7.5%. This section is a quick way that you can see maybe if the market is down or is high. Okay, because you have the national average here. Okay, let's see. Sales are going up, excuse me, from a year ago, almost 100 transactions more. Okay, remember, here in industrial, we don't have a lot of transactions since we are dealing with huge space. It's not like single family homes that we have millions of homes sold. Here we have, as you can see, 1,000 transactions this year. Excuse me, last year, 2025. I don't remember. We are already in 2026. Okay, existing buildings, inventory. Okay, vacancy. We can see here some graphs how how we are compared with other years. Okay, so we can see the vacancy rate is all-time high right now. So, and this is not to fear, because this is for all the US markets. It went a little bit down because of the tariffs. It's a macroeconomics things. But as I've told you before, and well, this is a phrase from Warren Buffett: when people fears, you have to be greed, and when people it's greed, you have to fear. Remember, you have to do the opposite. So that means if the vacancy is high, maybe some investors they will say, okay, the market is not good because it's all-time high, the vacancy. Okay, but remember, when everyone else thinks uh, the things are going bad, that's when you have to invest. Okay, so we see, for example, absorption, it's all-time low. Also, we can see, for example, a huge absorption 10 years ago, 2017, almost 23 million square feet absorption. That was a huge. Okay, market asking rent is all-time high. Okay, leasing, vacancy. We can see here, for example, comparison on the vacancy and the vacancy in the US. Net deliveries in the first quarter of 2026, we have positive net deliveries. Okay, that means developers and investors, uh, developers most are still investing, are still trusting in the market. Okay, net absorption also positive, people moving in more than moving out. Okay, so investors are trusting in this market. Okay, a little bit down absorption at the end of the year. Okay, so that means some things. For example, if we want to purchase and maybe to rent it out, then we may face some struggle to rent it out at this year, but then uh, uh, things get easier at the end of the year and the years that comes ahead. Okay, leasing activity. Okay, vacancy rates. For example, here you can see the vacancy rates along some uh, different types of industrial assets. For example, in Dallas, the logistics spaces or the flex spaces are usually the ones with the lowest vacancies. But here in Atlanta, in Georgia, in Atlanta, we see specialized assets are the ones with the lowest vacancies. So that may means that specialized other or the manufacturing buildings may have more demand than other kind of spaces. Okay, so that comes up for making or cooking up the strategy I'm gonna tell you in the next minutes. um, Daily vacancy, availability. Again, availability is lowest on specialized. You are starting to see the the dots connecting. Okay, connecting the dots. Available square feet, total share of sublet. Okay, we see sublet increasing from 2022. Not a big deal here. Asking rent, months on the market, not two-step rise on the months on the market. Months to lease, vacant, probability of leasing in months, 50% on 5 months, in 8 months, 9 months, 77% probability. So that helps us know how long are we going to take to lease the space. Okay, rent, marking, asking rent, growth, asking rent per square feet, growing also. And also we see manufacturing. Usually flex is this is this is common that flex buildings are the high has the highest rent overall all other kind of spaces. But we see here manufacturing to be uh, the second one in this market, the second with the highest rent. Okay, in flex it's usually higher rents because they are usually uh, smaller spaces and they are usually close to the neighborhoods or consumption centers, like close to the downtown to the city. So because they are a service business mostly. Construction starts, deliveries and demolitions. We can see here, for example, net deliveries in the first quarter, positive, and we can see that with these net deliveries at the highest point, we can see they are taking no they are taking mostly new space. They are not demolishing properties, at least in the first quarter. Okay, second quarter, uh, some of them are demolishes, like 10% are demolishing places and are building new places. So sales. So let me tell you the strategy I'm starting to see here. Market cap rate. Let me see. Specialized. It's 6.5%. Okay, and logistics almost the same. 6.5% cap rate. Okay, manufacturing. It's the economy. Let's see some about the economy. Okay, manufacturing market current growth. It has a positive growth here. Um, okay, and historical growth over 10 years in manufacturing. We see trade and logistics. It's not as good as manufacturing. It has a negative growth. Job growth, unemployment rate. Okay, so what I see here, it's possibly because many because I see Atlanta as a Taiwan hub, Taiwan manufacturing hub. What is that Taiwan? It's like you can have big companies here. This is like the head of the whole thing. Okay, like manufacture, like automotive manufacturing, like Toyota, like let's say Volkswagen or some other big manufacturing companies, especially because this current administration, this current government, it's looking for foreign companies to invest and to come from for example from Europe. For example, I read like that Trump told BMW, or I don't remember if it was BMW or Mercedes Benz. They asked the CEO of this company to bring the headquarters to the US. Okay, so these companies are tier one companies because they are the manufacturing company. They got all the pieces, all the engines, all the tires, all the pieces of the car, and they assemble. They are assemblers basically. They assemble and then sell to the retailer. Those are tier one. Tier two companies are uh, like those manufacturing companies that manufacture the engines, the tires, all the parts of these cars. Those are tier two companies. And tier three are all the other companies, like those maybe manufacturing some plastics, on some let's say some bolts or some harnesses or some other minor things in the supply chain. So I see Atlanta as a tier one or maybe tier two hub, manufacturing hub. So if they are, if those companies from Europe or maybe even from Mexico are willing or are looking to move from abroad, from other countries to the US, which states do you think they will land? One of those maybe would be Texas, but Georgia or Atlanta specifically, it's a big bet for those companies because it has lower rents, it has lower labor, and it is close to ports and it is close to Mexico. So it has a magnificent location. So uh, I see Atlanta as a hub, logistics, manufacturing hub, because Dallas I see it more like a logistics hub. You manufacturing in Mexico, and then uh, you import the products here, and then you move all the products through the U.S. But in Atlanta, you can also manufacture. All those companies that are moving, Tier 1 companies, may may land in cities like Atlanta. Okay, so the strategy I'm going to propose, it's it's called build to suit. Build to suit, it's like a heavy weight strategy. It's not like for weak guys. This is for the big players. Okay, so what is build to suit? So you have a land. In build to suit, you first get the land, or maybe an old building, but that building you are going to demolish, you are going to tear it down. And then once you have the land, you go and look for the tenant. You go and look for the tenant, and you say, you tell the tenant, okay, let's say, for example, Mercedes. Okay, Mercedes, I have the perfect location for you. I have this piece of land in the middle of Atlanta. It's close to your labor you are going to need for your new plant when you relocate to the US. Okay, and it's cheap rent. It's close to Mexico, close to the ports. So I just have the land. Okay, but I can build it for you. I can build your plant. Actually, you don't have to purchase my land. I can build it, and then once I build it, I can rent it out to you. We can sign a lease for maybe 15 to 50 years, let's say, because build to suit leases are longer term. That's something you have to know. So you go with Mercedes, and they told you, okay, you build my plant, my manufacturing plant, and I'm gonna pay you this rent. Let's say I'm gonna pay you, I don't know, $12 per square feet. Okay, and here are the plans for my plant. Okay, then you go to the bank as a developer. You go to the bank, and you tell your banker, okay, I have this land, and now I have this lease from Mercedes, and they are going to pay me for 15 years. They are going to pay me $12 per square feet. So I need X amount of dollars, let's say $200 million to build the plant. So are you going to lend me that money? Because you have no risk. Okay, my tenant is Mercedes. He's gonna pay me this amount of money. So what do you think the banker will tell you? Of course, they will lend you the money. They will lend you the money to build that plant, and then to lease it out. Okay, so they will lend you for the construction and for the long term. Okay, so this is very good strategy for big players, big developers, because they have no risk. They have no risk, because otherwise the other kind of building, it's spec building. It's speculative building, because you build first, and then you look for tenants. You look to fill out with rents. Okay, so the bank has more risk and also the investors. Because what if you don't find those tenants, or the rents they're willing to pay you are lower than you initially planned? Okay, so spec, and right now spec, maybe it's a no go for the banks. But with a build to suit, with a good planned build to suit strategy, bank has no risk. Okay, so let's so that's what we are going to to do here. Let's build that build to suit strategy here. So what we are going to do, we are going to try to find some place. In this example, I'm going to try to find some old place, old manufacturing building. Why old manufacturing building? Because otherwise, if you want to go find land, it's very probable you will not find the land already zoned for industrial, because you need a big piece of land. Okay, so what you can do is you can find an old building, an old manufacturing building, or an old warehouse or flex that it's already zoned for industrial, and then you don't need to rezone there because it's already zoned. You just have to demolish. That's one advantage of this strategy. And the second thing is you can rent it out. While you get all the plans and all those things, you can rent out that building maybe to small tenants. But when you rent it out, you have to make sure that you rent it for not longer than 1 year. Okay, because you have to vacate that building when you get the permits approved. Okay, so that's what we are going to do here. We are going trying to find a big old building, industrial building, and then rent it out. And then when we have all those plans in place and permits in place approved, then we vacate the place and demolish and tear down that place. Okay, so let's look. So here, as I mentioned, I already showed you the market tab of this software, but we can also find sale for properties for sale. Okay, and also sale comps, even auctions. Okay, so oh my god, Atlanta. I don't know why every time I try to find something, it goes to Austin. I think they have Coastal have headquarters on Austin. Okay, but here we are. Okay, we have industrial. We select industrial, flex, and industrial flex. Yeah, it's everything. Industrial. Okay. Okay, what we are going to do, we have a system here in CoStar for stars. So we are going, 1 star, it's usually older buildings. 5 star are newer buildings on the main avenues of the city. So 72 properties here. Okay, let me filter up some by the year. So let's say abandoned. tenancy. I'm trying to find vacant properties, because if we purchase properties that are already leased out, we don't know what's the term of the lease, and we want only to hold the property until we get the permits approved and the plans done. So that will take maybe 1 to 3 years. Okay, so what if we purchase a property that has a lease contract for 5 years or maybe 10 years? Okay, so to be sure we don't have those kind of leases, I want to only filter vacant properties, but I don't remember how do I filter up 10 property size on the rental. Well, property size, let me property size secondary land area. What we are looking for is land, not the building, because we are going to tear down the building. So at least for a build to suit, we need 5 acres, I would say, for something serious. Okay, I would say 5 acres, and that's what I thought. Percentage list. Okay, so let's say max 10% list, 8 properties. Okay, max 10% list. It's mostly vacant. That's that property. So let's say 0%. Oh, 0% list, 8 properties vacant. These properties are vacant. Okay, so let's see. This is built 1963. 2025, 1972. Nineteen 69. Okay, and we have here 11 acres. Okay, 2 properties for sale. Okay, let's say this one, active land, 8 acres, 7.5 acres. Okay, and we have this one in 1971. Let's see how. Okay, good. This is good. Okay. Okay, so we found 3 properties here, 3 big properties. This one, the first one, they are asking 10 millions for this property. 10 millions. It's 59,000 square foot warehouse, but it has a huge land. It has almost 10 acres. That means we are not wasting a lot of money because we want land, remember? We want land, and we are going to waste to demolish this one. And we are only demolish a small building. Okay? So this is good because we are almost full paying for the land, not for the building. Okay? 10 acres here. And then we have this one. It's 7.5 acres. And it doesn't say how much they are asking. Okay? This is also an old building here in Atlanta. Okay? And then lastly, we have these two buildings property. It's 11 acres. The price they are asking, it's not disclosed. Not disclosed. So we have these three options. Okay. Let me select this. And let me select this one. And these two properties. Okay. 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 I don't know where it go? Where it went? Okay. Oh, let me try. Okay. No, this one. No. This one, it's all. I think this is better. Okay, we have two good parties here. And then we have okay, this one. 1963. Okay. Okay. I don't know why I can't select this one. Okay, let's select this one and then select these other two. Okay. Okay, so we have these three properties. First one, I'm gonna give you 1 minute to help me to choose one of these properties to purchase for. The first one, it's 655 Great Southwest Parkway in Atlanta. They are asking 9.8 millions, and we have almost 10 acres. Okay, let me see. They have 9.5 acres. Then we have very close to that property, we have another property, almost same size of the land, and they're asking 9.9 million. Okay. And the third one, we have this. Price is not disclosed. We have a lot more of rental building area, but remember, we are going to tear down this place. And price not disclosed, and we have 7.5 acres land. Okay, which one do you want me to analyze? The first one, 655 Great Southwest. Second one, 675 Great Southwest. And the third one, 1300 Estes Drive. Which one do you want me to analyze? Let's start the pool. Okay, 1 minute. So all of them are well located. They are close to the highways. Okay. This one is close to the downtown. But we are not too far from the city. So we are close to the blue collar jobs. So we will not have any problem getting any labor go to work at those sites. Okay. So let me see if you have any comment. Okay. Okay. So again, we have 655 Great Southwest, almost 10 acres, asking 9.8 millions. 675 Great Southwest, asking 9.9 millions for almost 10 acres too, close to the first one. And the third one, 1300 Estes Drive. Okay. Okay, 7.5 acres, and we have not disclosed price, but looks like very deteriorated property. Okay, so let's see what we have. So we have a winner, 655 Great Southwest. Okay, so we are going to see what can we do with this building. So let me explain you again. So we are going to purchase this building, or going to analyze if we purchase this building, and then rent it out. And then once we rent it out, we go to find a build-to-suit tenant. Okay, and once we find a build-to-suit tenant, we apply for the permits, draw the plans. First draw the plans, then apply for the permits, and then vacate those tenants and tear down that building and build a new building. That's what we are looking to do here. So if we purchase this building, let me see how much land area we have. 9.5 acres. Okay. Okay, let me see. So I'm going to make a fast calculation. How much are we paying by square foot of land here? Okay, so we have 9.5 by 43,560, which is the square footage. And then they are asking 9.81 million. Okay. Okay. Divided by so we are paying $23.7 per square feet here. So I don't think it's a at least compared to Dallas. I think Dallas here from at least for comparable properties here, square feet price of land, it's around $40. $40. So we are half of that. Okay. Of course, it's variable. It's another market. It's another location. But this is a quick calculation. We can realize if we are high, if we are paying too much, or we are paying a fair price or maybe low. Okay. So the other way we can find out, it's with the cap rates. Okay. So for example, let's see how much we can get in rents here if we rent out this property. Okay. Vacancy, sales, inventory, rent, market, asking rent. It looks like a logistics property, so will be around $7 per square feet. The rent $7.35. Let's say $7. Cap rate. Let's see the cap rate. It's around 6%. It's a good cap rate. Okay. So since those are, I guess those are triple net leases. So that means most of it is net or gross profit. So we just divide the $7. Okay, let's say. Well, maybe this is not a fair valuation because we have too small space for too large piece of land. So this will be maybe would look we are paying too much because it's a small building, but by the number by square feet, the price per square feet, it's a good one. But if we do it by the cap rate, we just do the, let's say, 50K square feet by $7. Okay, $500,000. Okay, divided by 6% cap rate, that goes 7 million. So that may mean we are paying too much for this. But remember, we are not paying here for the cash flow. We are paying for the land. So it's better to do evaluation by the land. Okay. So evaluation for the land, to get the valuation for the land, it's more complicated. I don't think I can do it here. But basically, it's an easy way to do it. It's how much it's worth, or how much is valued a new building, and at 20 to 30% will be the land cost. Okay, so let's say we build something here. Let's say we have a floor area ratio here. Let me see if we have that information here. Floor area ratio. It's point. Okay. Okay, this is the one that it's built right now, but I don't think it will be the zoning. Okay, this is the portion of the building that occupies on the footprint. Okay, but I don't think this is the zoning. Uh, Mostly the zoning for industrial is 50% floor area ratio. So that means if we have, let me find again. $400,000 square feet. 20. Okay, by 50%, we can build 200,000 square feet here. Okay, by the zoning. So basically, we are going to do fast numbers. Basically, if the construction cost here will be around, I would say, because it's a big building, I will say around $100. It's an industrial, 100 or 220 to, let's say 120. So we multiply this footprint by 220, and we have excuse me, it's 120, not 220. Okay, we have almost $25,000, $25 million, excuse me, $25 million construction cost. Okay, so usually construction cost will be around 70% of the value of the building. Again, we are doing fast numbers. We don't have the time to do a cash flow or something very complicated. We are trying to find out how much we are paying for the property. Okay, so that will be the construction, 25 million. Okay, 25 million, and that will be the 70%. So we divide by 70%. Okay, so the sale value of that property will be around 35 million. 35 million. So I already told you the price of the land, it's most commonly 20 to 30%. So we multiply this by 30%, it goes to 10.6 billion. So that looks that this property is on price. It's well priced. Again, this was a fast calculation. Okay, we just find how much it's how much is going to cost the building, the new building we are building for Mercedes or the big tenant here. That will be cost around 25 million. Okay, only the construction cost. But since construction costs are usually 70% of the value of that building, the value will be around $35 million once we have the new Mercedes plant here. Okay, so usually the cost of the land will be 20 to 30% of the, sometimes it's more, okay, of the project. So that will be 10.6 billion. So that means we are on a fair price, asking 9.81 million. Okay, and remember, we have a building here. We can rent it out for while we make the plans, get the permits approved, and we have some extra cash flow here. Let me do the fast calculation. How much can we get here? So we have 60,000 square feet. If we rent it out by $7, as the market data shows, we get $500,000 a year. Okay, for 3 years, we will take for the project. It's what 1.26 billion. So that's extra money for ours. Okay, so that's how you basically, in a fast way, that's how you make a build to suit strategy, and to find out how much would you pay for an old building that basically you want the land to wait until you find the build to suit tenant and build your new multi-million-dollar project. Okay, so what do you think? I hope you like this video. Thank you for watching this. Thank you for reaching this point. I know sometimes I'm very boring. I know something my English sucks. I know, but I'm trying my best, and I really thank you. You reach this point. You watch this video, and if you have any comment, maybe you are not agree what I just said. Maybe you will do other strategy here in Atlanta. Leave it on the comments. I have my channel, my YouTube channel, or in this LinkedIn live. You can leave it on the comments. I will love to see what you think. Okay, and if you would like, if you are already an investor and in those looking for industrial or office property, I'm a real estate agent, and I'm experienced real estate agent specialized in industrial and office assets. I help my clients invest in the best industrial assets through the US. And you can contact me. I will leave you my link to contact me. And I can help you with that. I can help you with purchasing a building or maybe selling a building here in the US. So I will leave the link in the description. So thank you. Give me a like in my social networks. Follow me, YouTube, Instagram, LinkedIn. Follow me, leave a comment, and thank you. See you in the next one.